Investing in public markets as a youngster? Seth Klarman's advice is a way to go. Seth Klarman, a legendary investor known for his exceptional track record, recently broke his 12-year silence to share valuable insights on outperforming the market and his current investment focus. With an impressive average annual return of 20% over the last 30 years, he has earned praise even from Warren Buffett, who considers him one of the select few he would trust with his own investments. We'll look into this exclusive recent interview, which provided investors with valuable insights from a trusted figure in the world of investing. I'm sure that by the end of this video, you'll have a better understanding of the public market, so watch till the end. Today, we'll also learn about the important and knowable principle that will guide you in today's complex markets and find hidden opportunities in a world dominated by short-term thinking and market ups and downs. We'll reveal a path to long-term financial success where patience and discipline are your best friends. So don't miss out on the keys to lasting value investing. Seth Klarman's legacy is here to help you. Klarman is known for his low-profile approach, rarely granting interviews or seeking media attention. However, he recently made an exception by participating in a rare interview where he discussed various topics. During his interview, he shared his perspective on the current state of the market, his outlook on the future of the economy, and most importantly, the investment opportunities available in today's stock market for people of any age. Is market efficiency an unchanging trend? Klarman talked about the current view of public markets as compared to when he began his investment journey in 1979. He highlighted how markets have evolved and become more efficient over the years, but emphasized that there are still opportunities within them, primarily driven by short-term thinking and erratic pricing. Market efficiency and inefficiency. Klarman acknowledges the overall trend towards market efficiency over time, but raises a critical question about whether markets can become less efficient after reaching a certain level of efficiency. He notes that short-term focus in today's markets may create opportunities for pricing inefficiencies. Short-term orientation as a source of inefficiency. Klarman observes a prevalent short-term orientation in contemporary markets. He points out instances like Meta's stock experiencing significant price swings in a short period despite being a well-established company. This volatility suggests areas of potential inefficiency. Seeking opportunities in inefficiency. Klarman's advice to young investors is clear. Focus on finding the most inefficient pockets within the market. These are areas where market participants may be overlooking long-term value or reacting to short-term noise. Young investors should recognize that such market volatility can create opportunities for those with a long-term perspective. Emphasizing a patient, disciplined approach allows for better risk management and more deliberate investment decisions. It's essential to conduct thorough research, assess fundamentals, and seek professional guidance when needed to navigate short-term market dynamics effectively. By understanding the impact of short-term orientation, investors can capitalize on long-term value while avoiding the pitfalls of reacting to fleeting market sentiment. Klarman further gives key advices that can change the way you invest. 1. Importance of mentoring. He discusses the value of mentorship in the investment industry. He suggests that most people may not be ready to jump into the world of investing right after completing their education. Guidance and mentorship can be instrumental in developing a successful career. 2. Leveraging personal interests and expertise. Next, Klarman advises young investors to assess their interests and unique strengths. For example, if someone has deep knowledge of a particular country's business culture or strong contacts there, they should consider leveraging these advantages in their investment career. 3. Choosing your path wisely. This one is so important. Klarman encourages aspiring investors to align their career choices with their natural inclinations and interests. Investing in areas that genuinely intrigue them is more likely to lead to success and fulfillment. 4. Caution in high-flying markets. Klarman's final piece of advice is to exercise caution in markets that are consistently hitting all-time highs. Such markets may present heightened risks, and he suggests that investors should think critically before committing capital in these conditions. Klarman's wisdom suggests that young investors should be on the lookout for these pockets of inefficiency. By identifying areas where market participants are overly focused on short-term gains or where markets are subject to wild fluctuations, investors can uncover opportunities that may be undervalued or overlooked. He underscores the importance of adopting a long-term perspective, aligning with his own successful investment strategy which has spanned several decades. Understanding the important and knowable principle in investing. Seth Klarman's approach to investing revolves around a fundamental principle known as important and knowable. This concept, originally coined by Warren Buffett, can fundamentally change the way investors think about making investment decisions by helping them focus on what truly matters in the vast sea of information available. 1. Identifying what matters, important. The first aspect of the important and knowable principle is determining what truly matters in the context of an investment. These are the key factors that significantly influence a company's success and its long-term growth potential. For instance, these factors could include the financial health of the company, the future prospects of the industry in which the company operates, the quality of the company's management and leadership, the anticipated direction of interest rates, the state of the broader economy and its potential impact. 2. Assessing what can be known, knowable. The second part of the principle involves evaluating whether these important factors are knowable. In other words, can investors gather reliable and actionable information about these key aspects? This step is crucial because even if something is important, if it cannot be reasonably understood or predicted, it may not be a suitable basis for making investment decisions. 3. Focusing on productive analysis. Klarman's approach is to concentrate on analyzing bottom-up individual situations, such as stocks, bonds, and real estate transactions. He avoids spending excessive time on areas where the answers are uncertain or imponderable. By doing so, he aims to allocate his time and resources more productively, focusing on factors that will truly impact his portfolio. 4. Applying the principle to cryptocurrencies. Klarman's mention of cryptocurrencies, like Bitcoin, reflects his approach to important and knowable. He acknowledges the excitement surrounding cryptocurrencies, but highlights that he cannot find clear value in them. Therefore, he chooses not to invest in them, as he perceives the arguments and the underlying value as uncertain and imponderable. So in short, the important and knowable principle in investing is about honing in on the factors that genuinely matter and can be reasonably understood, thereby guiding investors toward informed and productive decision-making. This principle underscores the importance of focusing on what you can reliably know and analyze in the context of investment opportunities. Why Seth Klarman's investment philosophy centers around focusing on factors that are knowable, as opposed to factors that are unpredictable and uncertain. Seth Klarman's investment strategy revolves around prioritizing factors that are knowable, because it aligns with a cautious and risk-conscious approach to investing. Here's why he places this emphasis. Risk management. Unpredictable elements like sudden market shifts or macroeconomic events introduce higher levels of risk into investment decisions. By concentrating on factors that can be understood and analyzed using available data, investors can better manage risks and make more informed choices. Long-term view. Klarman stresses the importance of taking a long-term perspective in investing. Factors like a company's financial health and the quality of its management typically have a lasting effect on investment success. Predicting short-term market movements is challenging and can lead to impulsive decisions that harm long-term objectives. Consistency. Giving priority to knowable factors encourages consistency in investment decision-making. It encourages investors to rely on fundamental analysis and research instead of trying to time the market or make speculative bets based on unpredictable events. Risk-adjusted returns. By focusing on factors that can be known and controlled, investors can aim for better risk-adjusted returns. This approach seeks competitive returns while managing and reducing potential downside risks. Emotion control. Investing based on unpredictable factors often triggers emotional responses like fear or greed. These emotions can cloud judgment and lead to impulsive actions. Prioritizing knowable factors helps investors avoid decisions driven solely by emotions. Informed decision-making. Klarman's approach promotes thorough research and analysis, fostering a systematic and disciplined investment approach that can result in more rational and informed decision-making. Seth Klarman's emphasis on knowable factors underscores a practical and calculated investment approach designed to minimize uncertainty, mitigate risks, and promote long-term financial success. This philosophy aligns with the principles of value investing, which stress a focus on fundamentals and a patient investment horizon. Here's how you can do it. 1. Financial health. Assessing a company's financial stability and performance is crucial. Investors can readily access financial statements, including income statements and balance sheets, to evaluate profitability, liquidity, and overall health. This information provides insights into whether a company is well prepared for sustainable growth. 2. Management quality. Information about a company's leadership team, their track record, and strategic decisions is available in annual reports and news sources. By evaluating management quality, investors can gauge a company's ability to navigate challenges and create shareholder value. 3. Future industry prospects. While predicting the future is impossible, assessing industry prospects involves analyzing current market trends, competition, and growth potential. Staying informed about industry dynamics helps investors identify sectors with growth potential, guiding their investment decisions. 4. Future interest rates and economic conditions. Predicting future interest rates and the state of the economy is highly uncertain. These factors are influenced by numerous variables and external events, making precise predictions challenging. Instead, investors can focus on building flexible portfolios that can adapt to various economic scenarios. By concentrating on the knowable, investors can make informed decisions that align with their goals and risk tolerance, making their prospects for long-term investment success. In a world where market trends and investment strategies often change rapidly, Klarman's advice encourages young investors to remain patient, focused, and disciplined in their approach, ultimately aiming to capitalize on the enduring principles of value investing. I hope you liked the video, and I'll see you in the next one.